Real estate sure can be confusing. I mean, do I buy the bigger nice house and make $20,000? Do I buy the smaller ugly house that could make me $100,000? It can't be that simple. What are all the factors in determining which investment property I should buy and which one I should run from?
One shot, now the future is yours. Go!
What's up, Kris Krohn here. Today we're gonna dive in on the game of real estate, and it's all about answering this question. How do you know if an investment property is worth it? I gotta tell you, over the years, I think this is the pain point of confusion on why some become investors and some don't, and why some, when they become investors, either succeed or fail. Do you actually know what you're looking for? Do you actually know what makes something a good deal? Having transacted over 6,500 properties, I want to tell you something I've learned in the last 2 decades. There are 5 key things that you need to understand when evaluating a property. Number 1, location. Like you've heard location, location, location. Number 2, we're going to look at the condition of the property. A better condition doesn't mean gooder. And then appreciation potential, like am I in a market that appreciates well or horribly? Number 4, we're gonna look at financing and your investment goals, because sometimes we're chasing the wrong real estate that actually isn't gonna get us to our goal. And then finally, rental potential and cash flow, as in, depending on what the strategy is, like when the math hits and the money hits the bank account, will I be proud of my investment or will I be thinking, this is an ugly red-headed stepchild?
You don't know me.
All right, number 1, let's talk location. You understand that there are 324 markets that make up the United States. When I originally became an investor, I invested in my backyard. For the last decade, I have bought nothing, no real estate in my backyard. And yet it's not like I expect you to be able to say, well, Kris, I don't know if I'm ready for a nationwide search. Like if I just wanted to invest in my backyard, what would I be considering in terms of location? Well, number 1, you want to research the neighborhood carefully and you want to consider things such as, is it close to schools and public transportation and shopping centers, job opportunities? Look for areas with low crime rates and a stable or growing real estate market. And finally, neighborhoods with a history of appreciation tend to be more attractive long-term investments than other neighborhoods that seem to always be struggling. All right, the second factor in determining whether this is going to be a good investment or not comes down to the condition of the property. Check out this lovely image. You might look at this and think, that looks like a problem.
We'll take the house.
And when I see a problem, you know what I see? I smell money. Assess the condition of the property both inside and out. Consider hiring a home inspector to identify any hidden issues. If you are very serious about buying the house and you pay a few $100 for an inspector, they're going to be so meticulous that they're going to red flag any issues, especially the dangerous ones that you may not be thinking about. So beyond what you can visually see, an inspector can go a little bit deeper and find some things like that. Basically, it allows you to calculate the potential cost of repairs and renovations and basically what the property needs to get it livable. When you do see a property like this, I will tell you there's a lot of people that think that looks like a nightmare. But depending on the price, I'm happy to have that dream. I'm gonna tell you right now that when you're making money in real estate, a big part of the future earnings come from something called appreciation. As in like, well, Kris, when I rent out the property, there'll be positive cash flow. That's good. Well, there's also tax benefits. That's good. But the real benefit is the longer you hold that property, you understand over the last 65 years, that nationwide, there's an average appreciation of 4.6% year over year for 65 years. Now round it up, call it an even 5%. You might be thinking, Kris, 5% doesn't actually sound like a lot. But remember, you haven't bought this cash. You probably put a 20% down payment, which means that you have a 1 to 5 leverage ratio, which also means that the appreciation benefit is also 5 to 1. That means that you're not going to get a 5% benefit, you're going to get a 25% benefit. Already your money, whatever you've got in here, is going to earn so much more than a 401k, an IRA, or anything else because of this word, appreciation. Consider the property's potential for appreciation over time. Look at the market trends in that area and gauge the likelihood of property value growth. Focus on properties in areas with strong economic fundamentals and potential for future development or improvements, because appreciation is ultimately determined by, is this area growing? Is there job expansion in this area? Is this an area where people are moving into or moving away from? And here's what I'll tell you. If jobs are booming, if the local government is stimulating growth in a certain area, if people are migrating to that particular area, it's going to have a high appreciation rate. But also the opposite is true, that if people are fleeing the area and it's getting more and more run down and no one is dropping stimulus and money into that area, don't buy there. Number 4, let's talk about financing and investment goals, because if I'm gonna buy this house for a flip, I need to evaluate it one way. If I'm gonna buy it as a rental, I'm gonna evaluate it a different way. Evaluate your financing options, including down payment, interest rates, and loan terms. Explore both traditional mortgages and investment property loans. What we're trying to do here on the financing game is basically say, all right, if I buy this house, I may have to bring some money to the table as a down payment, unless I'm gonna get creative. And that means that the bank is going to basically say, with today's interest rates and with that down payment, and with these loan programs, I think your payment on the house is going to be $1,800 a month. Now, why is that important? Well, if it's a rental and I can't rent it out for $1,800 a month, then I'm gonna go negative. And I'm sorry, I don't wanna buy a house that costs me money every single month. Instead, I'm looking for properties where it's like, yeah, the mortgage is gonna cost me $1,800 a month, but people in that area rent for $2,300 a month. So I'm like, oh, that's a $500 more cash flow. That's a positive cash flow. Clarify your investment goals. Are you looking for long-term wealth accumulation or short-term cash flow? Your investment strategy should align with your financial objectives. Likewise, if I'm going to flip this property, then I don't care about cash flow, and I don't care how high the interest rate is, and I don't care the terms of the loan. You know why? This sucker's gonna be gone in a few months, which means I don't care about any of those terms because I'm not holding on to the house. And when I sell it, I don't really care. I probably care that I don't want a prepayment penalty because I know up front, I'm not gonna hang on to it. And number 5, let's evaluate. If this is a longer term play, then I wanna look at the rental potential and I need to understand the cash flow. Determine the property's rental potential by researching local rental rates for similar properties. Calculate your potential cash flow. Positive cash flow is a key indicator of a successful investment property. This is your most important factor when looking for a long-term investment property. And I wanna share with you another little secret. When it comes to producing cash flow, not all homes are created similar. Like if you just go and find a good deal on a house, it doesn't mean that it's gonna have a positive cash flow. Let me give you an example of what it looks like. This is a house in Porterville, California. The price is $375,000. The monthly cost is $2,500. And the rent value, according to Zillow, is $1,900 a month. So let's look at this cash flow. My mortgage is $2,500 a month, but I can only rent it out for $1,900. This house is gonna cost me $526 every month out of my pocket if I buy it. The only way I can make this positive cash flow is if I put an even bigger down payment. So instead of 20%, meaning 70 grand, maybe I have to put down $150,000 just to break even. Do you think Kris Krohn would ever buy a house like that? No, but check this out. In Memphis, Tennessee, this house sells for $275,000, so about $100,000 less. Its mortgage is not $2,500 a month, it's now $1,800 a month. But Zillow says it's gonna rent for $2,386. So instead of a negative cash flow of $500, this has a positive cash flow of $555. In other words, one of these houses is going to be a better long-term investment than the other. Listen, you're wondering about the 324 markets and the 5 that I invest in. Memphis is one of them. Florida's another one. Arkansas is another. In those markets, I've set up infrastructure, and the reason why I go there is because I can outperform real estate rentals anywhere else in the country. It's where I can make ROIs not of just 25%, but of 30, of 35%. And over the next couple of years, it's gonna be juicier than that because of the landscape right now with interest rates dropping heavily next year. So check it out. If you have $50,000 or more sitting in a 401k, an IRA, or even equity in your home, you're like, geez, I wish I had a way of successfully putting that in these hot markets. You can. I will actually do it 100% for you. In fact, every day, somewhere, someone in the world watches this video and says, Kris, I want to partner with you. And they usually put up the cash from one of those retirement accounts. I bring me and my team of 100 experts to the table, and we make magic happen where I do all the work and we get to split all the profits equally. You will be better off doing it with me than doing it on your own, because together, 1 + 1 = 11. And the reality is, at the game of retirement, if you want to have millions of dollars instead of hundreds of thousands, click the link below, learn about partnering with me, let me show you how. Would you like to know the 5 exact markets that I'm invested in right now? If you click this video right here, I'll show you what they are, I'll show you why I'm there, and you'll understand how to really crush it as a real estate investor.